What's going on, everyone? Welcome to Real Talk Real Estate. This is Mortgage Monday. I'm David Green, and I'm here with Christian Baschelder, Big Brain, the Lone Ranger, and father to the Mortgage Mutt. Christian, how are you today?
I'm doing pretty good. Pretty good. Glad to be here.
Your hair looks really good, by the way. I said that last time, and I'm a little
I
jealous
did
of it.
cut
I
it
can
all
admit that.
off. This is my headphone. You can probably see my headphone indent right there. I've been talking to the rest of the one brokerage all day.
Yes, you have. And we are rolling, just a public service announcement. We are looking to bring in new mortgage loan officers. So if you know a loan officer, if you are a loan officer, we really need more people to keep up with the demand that we're experiencing. And this is happening at a time when other places are laying people off. So please do us a favor. Share the word about the show and the fact we're hiring with people that you know. How many unread text messages do you have today so far?
Oh, scares me to think about. Probably 100 plus from clients that I promise I will get back to each and every one of you today.
Oh, he's going to be
But
working until midnight to get back to you guys, but we're taking a break to
that's
record
right.
the show for you.
That's right. But yeah, it's if you are a loan officer, especially with experience, you know what you're doing. You know the non-QM market, you know the conventional market. Reach out. We have incredible resources here, incredible abilities to help you scale and grow your business and your performance. You're looking for something that's a little new and unique and gives you an ability to kind of raise that ceiling. Reach out.
All right, in today's video, as you saw from the thumbnail, Christian and I will be talking about 5 things that will lead to interest rates going up. A lot of people have been sitting on the sidelines, whether they're waiting to refinance or they're waiting to buy for rates to come down. We're all looking for those 3% rates that we really took for granted when we had them, much like that romantic partner that you think will always be there. They won't be. You got to love it while it's there. And now they're gone and people have been waiting, but they might be getting worse. So we're going to talk about 5 things to look out for that will likely lead to interest rate increases. And a lot of this has to do with the tariff talk. So Christian, you were mentioning something right before we started recording about the latest in the battle of the Titans between Trump and Powell. Can you share what that was?
Yeah, absolutely. No, obviously, I think everybody knows, but just for reference, Jerome Powell is the head of the Fed, right, in America, and obviously Trump's the president. And Trump appointed Powell back in his first time around in office, and they've been definitely two titans going at it. You think of like those big, crazy, epic fights in like a big sci-fi movie, right? And the update, David, is Trump has been kind of pounding the desk, saying, Powell's a doofus, and I'm going to fire him, and questionable about the legalities of can the president actually fire the Fed of the chair of the Fed. But he just came out today. We're recording this April 22nd, 2025, obviously. And he just announced, I have no plans now or in the immediate future to fire Jerome Powell, which sounds like a very, David and I were joking, sounds like those lawyers in the background said, hey, why don't you just say this just to settle the waters a little bit here? Because you definitely don't want the president and the Fed arguing. That's two people that it's very beneficial to have on the same page. But I think that's funny because that's a pretty big about face from what we've been in the last week or so, right?
Yeah. It's kind of like that dynamic between them is Powell does what he wants, what he thinks is best for the economy. Trump does what he thinks is best for the economy. It's like your head coach calling a play and your point guard saying, I don't want to run that. And you can't make me. It's in my contract. So I think Trump is frustrated that he's making certain moves like that he thinks are best for the country, which would be tariffing other countries, trying to bring manufacturing back here. He knows that's going to lead to higher prices. So he wants rates to come down to balance out the affordability issue. Powell is concerned that if he increases rates, it's going to lead to higher inflation, which if you measure inflation by the price of things, tariffs is likely to increase it. So they each have the same view of the problem, but they have a different solution in mind for how to fix it. And I think they're just frustrated with each other. The players like, let me call the play I want to call in the field. And the coaches like, call the plays that we're working on because we got a strategy up here in the box. And this is going on. So if nothing less, it makes for good TV watching these two go back and forth. And speaking of good TV, there's a lot of talk. I mean, in my adult years, I don't know if I've ever seen as much new information hitting the airwaves as fast as it is about changes to the entire country's economic foundations through this tariff and the talk of returning to manufacturing. And interest rates on mortgages will be affected by a lot of this. So we're going to talk about 5 things that we think everyone should be watching for to determine if rates are going to go up. And I'm going to have Christian explain why he thinks that they could go up or what would make them go up on each of the 5. So let's start with number 1. China selling U.S. Treasuries. How would this increase mortgage rates in the U.S.?
Yeah, 100%. For those familiar and for those not, mortgage rates are fairly roughly correlated to the 10-year Treasury, right? And that's directly correlated by how many buyers there are for bonds in the U.S. market. Other countries are our largest buyers. We typically think of institutional buyers, Vanguard, BlackRock, State Street, as being like the buyers that buy everything. Not with U.S. bonds. Countries buy U.S. bonds, right? And they hold a lot of our debt, meaning when those rates go up, we actually owe China more money without a service actually being exchanged, right? China lent us money and we have to pay debt on it, just like when you borrow money for your mortgage. Except the mortgage is the American economy, right? That's the collateral there. Now, historically, there's always been confidence in it. That's why they don't pay great returns. These are like 3 to 5% rate of returns. However, if they're, say, for instance, we're tariffing a huge country that has a lot of power, right? If they decided that they wanted to pull their investment into giving the U.S. government debt and receiving a return on that because of international disputes, because of tariffs, because of whatever, that means there are less buyers in the market for bonds. What happens when there's less buyers? It means you have to increase the buyability of that product in order to incentivize new buyers. Because if State Street, Vanguard, and BlackRock aren't buying debt at 4%, and they say, oh, we'll get in the market once it hits 6%, guess what? The market's going to have to adjust upwards. And with rates, it's backwards because you usually think like, oh, the value has to become less expensive to incentivize buyers to buy it, right? With an investment, the return needs to get higher in order to incentivize an investor to buy it. And basically that means bad for mortgage rates, right? Just to equate it easily, bond rates go up, it's going to negatively affect the rate you get on your mortgage, right? Because
that's right,
increasing that return for the investor. And even though on the show we consider our buyers our investors, the lender is the true investor here, right? They're the person giving you money and getting some rate of return in response for that.
They're investing in your debt. They're buying the note that you originated, and they want rates higher because they're getting a higher rate of return. The only thing that stops them from just insisting that you pay a really high interest rate, because that's what they want, would be if they go buy bonds instead. So those are the two things that they kind of go back and forth between. Do we want to buy mortgages or do we want to buy bonds? They're both relatively safe, similar risk profiles, and so similar interest rates. And that's why, like you said, Christian, they track together. This is different than the prime rate, which Jerome Powell actually does influence here. That's the rate that banks charge each other when they borrow money over the short term, which can affect indirectly mortgage rates. But we really track how bad do people want bonds? That's really what we're looking at here. And if China sells all their treasuries, there's going to be a lot of people that need to buy them, and they're probably going to go on sale. There's not as much need for it. Now, in the trade war, there's something going on kind of, I don't know if it's under the surface anymore. It's kind of come up to the surface, and that's China doesn't want to come negotiate with us. Instead, they're going to all the countries around them and they're saying, hey, let's make a deal with us instead of with the U.S. And the U.S. is doing the same thing. So you kind of have a divorce going on, and both partners are trying to get all their friends on their side in the divorce. And whoever can get the most allies is going to have more leverage when they actually come to the table to negotiate with each other. And one of the ways that China can hurt the U.S.'s negotiating power is to convince other countries to sell their treasuries that they own of the U.S., just like China is. So can you talk about that a little bit, Christian?
Yeah, and this is, it's funny because when I bring this up, I feel like a lot of people are surprised. If I were to just ask your listeners, who do you think holds the most U.S. debt from anybody, right, in the world? Probably like a huge percentage of people would say China, because I feel like that's kind of been pushed. Now, China holds a lot, but it's actually would probably surprise a lot of listeners. Japan is the biggest holder of U.S. bonds, and it's by a substantial portion. I mean, just a quick Google search, and you guys could check me on this. Japan, as of first quarter of 2025, their holdings exceed 1 trillion, 1.06 trillion was the data at the end of February 2025. China owns 768, so it's almost by a factor of 30% more. So while we're ticking off China, and their direct response may be to sell off U.S. treasuries to negatively impact mortgage rates and the economy and approval ratings of Trump and everything in between, what could honestly and shockingly be even more detrimental is if we piss off people like Japan, because they have a larger holding in these things that are so influential in our economy. And if you add on the UK, France, everybody else, like it's a substantially larger portion than China. And I think really the unspoken consequence of all this stuff that, mainly is focused at China is how it hit everybody else, David, right? He kind of came up with that list of the full across the board tariffs. not really as worried about pissing off China. It's the fact that we pissed off everybody else. And that simultaneous impact could have massive consequences if, now obviously since then he decided to delay the other tariffs by 90 days. But if that turns back on and he ends up honoring those, we could see a massive sail off from our historical allies, like countries like Japan. Right.
Now, if you're wondering what would stop these countries from doing that and really hurting our economy by driving interest rates up, it's because it would hurt them too. This is the problem with the partnership. When you hurt the other side, you also hurt yourself. When you help the other side, you also help yourself. And so the whole idea of renegotiating here is who can withstand the pain the longest, because if they sell those treasuries, now they have to reinvest that money into something else. How do you do that? And China is in the position where, as their workers are being laid off because they can't sell things here as much, they may have to print money to pay all these people to buy all these goods so that they don't just sit on a boat and go to waste, which would cause inflation over there. So it's not only America that's in this tough position. Everybody kind of is. And it's a situation of who's going to blink first and who's going to give something up. And America's bet is that we want them to give up the advantage that they've had for a long time and bring it into what our current administration thinks would be fair. All right, number 3, inflation from the rising prices due to these tariffs. How would that increase mortgage rates?
Yeah, I mean, simple enough. It's if everything costs more, everything goes up, and the Fed in turn will have their kind of classic lever that they pull is if inflation becomes rampant and we're trying to combat it, the most kind of direct approach that the Fed takes is increasing interest rates, which the David and I have had many talks on this and personally about, like, is this really the best way to fight inflation, right? With just moving the lever of the interest rate adjustments. But the ultimate idea is if you make money harder to come by, it'll make people spend less, therefore decreasing the demand, therefore driving down prices, which is in direct contestation to inflation. That's what the mindset of it is. There's varying arguments of whether or not it works very well. But that would lead, if inflation runs away, that would lead to Powell needing to make a decision of, hey, we got to combat this inflation. We can't keep going towards our target of 2% rates. We got to crank these and kind of hurt the economy in order to, give it some medicine, right? In the effort of bringing inflation back down.
So if you're a nerd like we are and you like this kind of stuff, the idea here is that increasing interest rates, it does slow down prices going up, but it doesn't do it in a healthy way. It just slows down how quickly money changes hands. So you're also decreasing how much taxes are collected. You're decreasing how much wealth is created. You're hurting everything in order to try to keep prices low. We would prefer to see actually removing currency from the system. There's just too much of it and it needs to find a place to go. And so that drives up the price of things when people go buy them, like everybody goes and buys real estate or multifamily properties, that pushes the price up too high. We'd rather just see you take out some of the volume of the currency as opposed to slowing down how often it changes hands. I really haven't heard many other economists present this position, and I'm curious if it's because I'm completely crazy and this is the wrong way to think of it, or it's just unconventional and they typically look at it like the easiest way to do this is to put up interest rates whenever you see prices going up and to put them down when you see unemployment becoming a problem. All right, number 4, Powell sticking it to Trump. How would this battle of the titans affect mortgage rates if Powell decides he's tired of Trump dragging him in the news and wants to lash back out?
Yeah, just imagine the scene of like Gorilla versus King Kong, just hammering on each other, right? But this, I hope, and of course the American public would hope that we're not making decisions based on vendettas, right? But words can get pretty spicy. When Trump, I think Trump called Powell a doofus the other day. Just throwing.
When's the last time you even heard that word?
I know, just like slinging insults. He says he's dumb as a rock. He's dumb as a rock. Which you can laugh about it, but in reality, you probably shouldn't have the president calling the head of the Fed dumb as a rock. He's not, right? They're not agreeing, and they have different viewpoints on what to do. Now, obviously, a negative side effect of this is two very conflicting views, and nobody really gets what they want, right? Really, they're supposed to have aligned interest, right?
Mm-hmm.
And while their aligned interest is there, bettering of the general economic environment in America, their views and their paths on how they envision getting there they're really starting to diverge quite a bit, right? And this is absolutely something worth considering, monitoring the relationship of Powell and Trump, because if we start saying, oh yeah, watch what I can do, and Powell just cranks it, that impacts us, right? Cranks the interest rates up 1% or whatever crazy stuff we can do. That would be significantly impactful, right? Whether for positive or negative.
Yeah, and if interest rates do go up on housing, that just slows down how many houses change hands. It slows down how much people make money in the economy. It makes housing less affordable. It really just damages an already troublesome economy. But it's difficult to separate the price of housing from the price of everything else, which is the problem here. So, number 5, falling stock prices due to tariff and company profit concerns. How would falling stock prices influence the rise of mortgage rates?
Yeah, this is a super interesting discussion, and this is the last one we'll end on. Historically speaking, there's a very strong correlation between when money in mass, in bulk, exits the stock market, it will typically retreat into the security of bonds. For instance, the government is a very low risk, right? Lending money to the U.S. government, it's not going to default, at least cross your fingers, right? Knock on wood. But typically when money exits the more volatile and less easy to predict stock market, it moves into the more standard secure government bonds. Now, we're seeing a little bit of a divergence from this now where money is just kind of pulling back, which is interesting. But historically, and just so that you guys understand it for context, typically on days where the stock market does very poorly, the bond market actually does very well. That's very, very, very common. It's not 100% across the board, but it's very common to have them inversely related. So that's something to keep in mind on if you guys, see something that you're thinking is going to impact the stock market, maybe a good time to lock in your mortgage rate, right? And we saw this 2 or 3 weeks ago when the tariffs were first announced, when he brought out his whole, banner with all the table, rates shot down. Right, they fell off a cliff those 3 days, and then obviously we've seen the results since then, and they climbed back up. But we had a day where I think the Dow was down 5 or 6%, and mortgage rates dropped by 0.5%. It was great.
Yep. Right? And you know what everyone said to me? Do you think they're going to keep going even lower? And then what happened?
My daily life, man, every day.
And what happened? Did they go lower, Christian?
They did not go lower. We had about 2 days of, theme park fun, and people got. If
you were ready and you locked in, you did great. Yeah. But if you weren't, they came right back up with a vengeance. And the greedy people, what's that phrase? Hogs get something and pigs get slaughtered. I don't remember. It has to do with greed, and people that were looking for them to get lower got hurt.
100%.
Solid point there. All right. So what are your thoughts on if you had to go 50-50, are rates more likely to go down in the near future or up? Where would you put your bet? Every mortgage broker loves this question, by the way.
Yeah,
this is the one thing I always want you to ask.
I would preface this by saying this is the hardest time in my career that I've seen in this industry of answering this question. Just harder than COVID, harder than everything prior to that. Right now, I think my long-term projection, 2 to 4 years, is still down. It's less down than I was 6 months ago, right? Mm-hmm. And I'm actually going to be probably part of the smaller few saying, I think in the next rest of this year, call it 7-8 months, I think they're actually likely to go up, which is not the thing that everybody wants to hear. It's not the exciting thing. I think it's very possible, though.
Yep. Okay. So what you're saying here is
projection up, my 2+ year projection down.
There we go. So short term, you think that they're probably going to go up, but long term, you think that they're going to go down?
So yeah, I think my projection the next 2 years, I do think the rates will come down. In the next 1 to 2 years, I'm probably in the minority where I think they may actually pretty high chance of going up. So we'll see. Obviously, nothing is guaranteed. I'm getting this question every day. But yeah, that's where I would put my my official mortgage guru prediction there.
Yeah, for what it's worth, I think the same. I think in the short term, rates are about to go up, and they're going to probably keep going up. And then long term, we're going to figure out a way to get them back down, get things chugging again. All right, Christian, thank you for this, and thank you for your insight there. And if you're listening to this, thank you for listening all the way through. If you would like to hear more about this, we have this episode, an extended version of it, on Apple Podcasts and Spotify under The David Green Show. Go log in and look up the Mortgage Monday episode with the same title to get a deeper understanding and further conversation about this very interesting topic. Christian, for those that want to reach out to you, get pre-approved for a mortgage, refinance, pull some money out of their portfolio, whatever, where can they go?
Yeah, best place to catch me at theonebrokerage.com is our, not at, but theonebrokerage.com is our website. Has a full list of how you can get in touch with us. If you want to shoot me an email directly, christian@theonebrokerage.com is where you can get me directly.
There you go. And you can find me at davidgreen24.com. Use the chat option to get a hold of me directly, or give me a follow on Instagram at davidgreen24. Let me know how I can help you. If you're still listening to this, thanks again. Make sure you leave us a comment below. Let us know what you think of the show and what you'd like us to do episodes on in the future. I'm David Green. He's Christian Baschelder. We're the One Brokerage. We'll see you guys next week on Mortgage Monday.